How to value complex assets for gift tax. Have you ever wondered how to properly assess the value of complex assets for gift tax purposes? It can be quite a challenge, but understanding the process can make a significant difference. Let's break it down into manageable steps. First, you need to determine the fair market value, often referred to as FMV. This is the price that a willing buyer and a willing seller would agree upon in an open market. It is essential to establish this value at the time of the gift. Next, identifying the type of asset is crucial. Different assets requiring different approaches. For example, publicly traded securities are relatively easy to value based on current market prices. However, complex assets like private business interests, real estate, or shares in limited liability companies need specialized methods. Professional appraisals play a key role in valuing complex assets. Engaging a qualified appraiser is essential. They will analyze financial statements, comparable sales, cash flow forecasts, and market conditions to estimate the FMV. Make sure the appraisal is well documented to withstand any scrutiny from the Internal Revenue Service. Now, let's talk about valuation discounts. These can help reduce the taxable value of gifted interests in private businesses or partnerships. For instance, a lack of marketability discount reflects the difficulty of selling the asset quickly. Similarly, a minority interest discount applies when the gifted interest does not provide control over the entity. Lastly, a lack of control discount accounts for limited influence over business decisions. These discounts can significantly lower the reported value of the gift, which may help reduce your gift tax liability. In some cases, you might consider using a formula or defined value gift approach. This method ties the gift amount to the final appraised value. It can help ensure that the gift does not exceed your intended tax exemption and offers protection during IRS audits if structured correctly. Documentation is vital throughout this process. The gift tax return must report the FMV used, supported by appraisal reports. Consistency in how you treat valuations across all gift documents strengthens your position in case of an audit. Be aware that the Internal Revenue Service often scrutinizes valuations of complex assets, particularly closely held business interests. Courts recognize the legitimacy of valuation discounts and formula gifts, but they requiring strong evidence and expert opinions. This is why professional advice is critical. In practical terms, incorporate valuation planning early when transferring complex assets. This can optimize tax outcomes. Use valuation discounts strategically to maximize the amount gifted within exemption limits. Regularly review your valuation methods and market conditions, as asset values can change over time. Understanding how to value complex assets for gift tax purposes involves determining fair market value, utilizing professional appraisals, applying appropriate discounts, and maintaining thorough documentation. By following these steps, you can navigate the complexities of gift tax considerations effectively.